Governor Jordan, thank you so much for speaking again to Bloomberg. Now, we caught up on the same rooftop a year ago. What's changed, actually, in your mind, or how we should look at the economy and inflation?
Well, especially in Switzerland, the inflationary outlook is much better. So we have now an inflation that is below 2%. If you look at our inflation forecast, it's below 2% for the entire forecasting horizon. This is a conditional forecast on the assumption of unchanged interest rates. So this is a very positive development. I think the measures we took during the last almost 2 years now were sufficient to bring inflation back in the range of price stability.
I think in December you said that monetary policy in Switzerland was adequate.
Yeah.
What's the way forward?
Well, we have our next monetary policy meeting in March. We will there have a new forecast regarding inflation, new forecast regarding the outlook. I think the big difference is now that the Swiss franc became stronger, especially in the weeks, in the last week of last year. We will take that into consideration as well. We already had some impact. The inflation outlook was lower, also due to the stronger Swiss franc. And we also made the point that after a longer period where we had the foreign exchange sales, foreign currency sales in the focus, this is not anymore a priority for us.
So, Governor, what does that mean? The market is expecting actually cuts, I think, as soon as June. Is that adequate or too optimistic?
Well, we do not really give any forward guidance on that. So I think the main tool for communication is our inflation forecast. At the moment, it looks like we have adequate monetary conditions. That may change. We will look at that in March very carefully, so that we have risk on both sides. So we could have more second round effects. So inflation could go up again. So we have, for example, rents, we have electricity, we have also the VAT that is pushing up a little bit. On the other hand, we have the stronger Swiss franc, we have a weaker economy, and we have more geopolitical risk. So that could then bring prices under pressure. So we'll see what the situation will be in March and then decide on the new information set.
But can you also, I guess, deal with this gravitational pull if the ECB starts cutting, if the Fed does aggressive cutting? What does it mean for the SNB?
Well, they mainly will react on their inflationary situation, and we do exactly the same. So the inflation differential plays an important role, but also the interest rate differential. And we take all those influences into consideration and then adjust our monetary policy, always with the aim to achieve or to maintain price stability in Switzerland.
You mentioned the Swiss franc. I mean, Switzerland has a strong currency. Actually, we haven't seen levels like this in a decade. What does that mean? Are you happy to just see it stay like this?
Well, I think we have to make a distinction between a nominal appreciation and a real appreciation. For quite a long time, we had mainly a nominal appreciation. That was very helpful because that shielded us from the inflationary pressure from abroad. Now, in the last couple of weeks of last year, we saw also a real appreciation. That makes the situation for some of our firms more difficult. We recognize that this is something that is not easy for them. And of course, this appreciation, as I said before, had already some impact on the inflationary outlook. It was not necessary anymore to increase rates in December. In September, we still said it might be possible. In December, it was clear that it was not possible. And it was mainly also the reason why we said the sale of foreign currency is not anymore a priority for us.
So what, for example, does a strong franc do with this inflation?
Well, at the moment, we still have positive inflation. So inflation may go back a little bit, but we still have also secondary round effects. So it's not a question that we have negative inflation in the near term. But of course, monetary condition in Switzerland is on the one hand given by the exchange rate level and on the other hand by the interest rate level. And the stronger Swiss franc means usually less inflation over the medium term.
It's very clear when central banks around the world started, of course, this huge experiment of raising interest rates. We were always told that it was the last mile of really fighting inflation that was the hardest. How do you think they're doing?
Well, all in all, I believe the reaction of monetary policy globally was right. So inflation came down quite a bit. In Switzerland, it's already below 2%, so we are in the range of price stability. We expect that that will be very similar abroad. Maybe it takes a little bit longer, but I think this is also a success of taking the right monetary policy measures. So in Switzerland, we were lucky, so inflation never exceeded 3.5%. We already took relatively early measures against the increase in inflation, by letting the Swiss franc appreciate and then also increasing the interest rate. No.
Do you worry? I mean, again, we're talking about Houthi attacks on possible oil tankers in the future. What does that do to, I guess, stability, the price of oil, and therefore how does it feed into energy and inflation?
Well, there's a lot of uncertainty, and I think when we have an escalation of these geopolitical risks and the deterioration of the geopolitical situation, that could have a very negative impact on the global economy, increasing energy pricing, having a very negative impact on the growth outlook. And we are a small open economy, so we are impacted immediately by that. And then we have to see what we can do best in order to adjust to this situation. But this is, of course, one of the big risks that we have, that we suddenly have a worsening of this situation with mainly negative impact on the supply of energy and on the price of energy. Yeah.
President Jordan, thank you so much for joining us.
Thank you very much.